Episode 16. There are 16 numbers on your credit card. We have 16 carpal bones when you count both wrists. Bobby Hull, Brett Hull, Bobby Clark, and Pat LaFontaine all wore the number 16. But let's be honest, the best athlete to probably wear the number 16 is going to be Joe Montana. And in the NHL and NBA, it takes 16 playoff wins to reach supremacy. Beyond MD, episode 16, here we go! Hey everyone, and welcome to episode 16 of Beyond MD. Hard to believe it's already been about a year, so that essentially makes today's episode the season finale. I've got a great guest. It's Dr. Kevin Mailo, who is an emergency doctor out of Alberta. He's also the founder of Physician Empowerment, and we're going to be talking about investing in real estate. So today's episode is going to focus more on direct ownership of real estate, which is obviously more active than passive. That doesn't mean it's bad, it's just more active. And remember, when it comes to real estate, there are passive ways to get involved as well. So you can look at a real estate investment trust or the lesser known Mortgage Investment Corporation, otherwise known as a MIC. And that's something that was covered in episode 12. So feel free to check that out. Now, before the interview, I want to make a quick point, and that is my role, again, on the podcast is to present information. It's never to tell anybody what they should be doing. Now, there will be times when I'm talking about topics that are maybe less understood, less recognized. Some of them are exciting. But I want to make a very important point, and that is, I don't think that a major decision should be made by listening to a single podcast episode. Sometimes the podcast may cause some excitement or may cause a light bulb to go off, but that's great, but we need to dig deeper. So, you know how Jennifer Dowdy from the Globe and Mail, she's an excellent writer and she analyzes companies in the Globe Investor section. But you'll notice that before each analysis, she says that the information is essentially a springboard for further research and one should be conducting their own due diligence. Well, that is absolutely true, guys, because I'm a firm believer that the best decisions in life are made with a lot of thought and care. But I'm out here to present information because I think that the more we know, the better off we're going to be. So that's just food for thought. And now off to the interview. So a quick introduction on Kevin Mailo. He's an emergency doctor based out of Edmonton, and he's the founder of Physician Empowerment. So Physician Empowerment is a venture that focuses on physician wellness. And part of it's financial literacy, but it goes beyond that and tackles topics like physician stress and burnout and how to optimize your practice. Now, I've gotten to know Kevin over the last year, and we've had a few conversations leading up to this, and I would say that his greatest strength is when he's talking to you, his attention is 110% on you. And trust me, that's not easy to do. And I have to say, every time I talk to him, I feel recharged, thinking really positively about the road ahead. That's just one of his traits. So I was really excited to bring him on here because one of the reasons we've connected is that we're both dreamers. That's how I describe us. You know, we're constantly thinking outside the box of bigger and better things. So without further delay, here's my interview with Kevin Mailo. Hey, Kevin, it is great to have you on here. Thanks for joining me today. And where does the podcast find you?
I'm doing really well. It's been a busy summer. So it's the summer of 2021 out here in Edmonton, Alberta, and things have opened up. And so clinical work is busy, busy with 4 kids and 2 medical practices in the house, but honestly, really good. And we're, as you know, I'm, the founder and of Physician Empowerment, and we've got a really exciting year ahead. So that's something that we're gearing up for starting in September.
So Kevin, that's one thing I wanted to ask you about because I find your background interesting. I find your venture, Physician Empowerment, really interesting because I think you guys are doing a lot of good work that's benefiting other doctors. So maybe, can you just give us a bit more on your background and Physician Empowerment?
Absolutely. Our background actually, like my background goes back a ways. My wife and I are both physicians. I practice full-time emergency medicine in the Edmonton area. And my wife is a pediatric neurologist and very highly accomplished, an incredible career. She's on a whole bunch of international research collaborations, gets invited to different places around the world to speak and things like that. And very, very proud of the careers we built in the house. But we actually met before medical school. And we went through medical school together. We had our first 2 children in medical school that were twins. And then we had a 3rd child in residency, and we had a 4th child shortly after she graduated her 5-year residency. So it's been a long road. And why I'm sharing a little bit about that is there's been a lot of issues with work-life balance. There's been a lot of issues with a lot of challenges with finances.
Mm-hmm.
And I remember graduating my residency program, 2+1 family medicine, emergency medicine. I remember graduating, I think we had somewhere around $300,000 in debt.
Wow.
Because we had 3 kids going to Jewish school,
Yep.
which wasn't cheap.
Yeah.
We one year we paid the nanny more than I made. There were weeks when our nanny hit overtime by Wednesday afternoons because my wife was doing so much call and I was away or wherever. And so we had a long road financially. And I remember that whole time worrying more and more about money as that debt piled up, going, oh my goodness, what do I do about this? And when I, had conversations with, preceptors or, classmates, or a lot of people didn't really know, what to do about, when to incorporate, or, tax planning or investing or how to pay for student loans and things like that. And, for somebody with the kind of expenses that we had, I did worry, and I felt a lot of insecurity about it. And eventually, it forced me to ask a lot of questions, and I found a great accountant, and, he took me through things, and, I incorporated before, for instance, before my first day of practice.
Mm-hmm.
And this was at a time when you could pay yourself dividends very fairly, and you could income split and things like that. And so I just paid out dividends to pay off those student loans very rapidly. But then, there were all these other questions about what to invest, what to do.
Yeah.
And I realized that, and I'm very proud of this fact or this facet of our profession. Many doctors do not know that much about money, investing, tax planning, incorporation. They don't know a lot about it. And the reason why I say I'm proud about this is because it really speaks to our devotion to our patients and to the healthcare system. That the vast majority of us did not go into this profession for the money. We went into it because we genuinely care. And that the finance, the practice management, that kind of all becomes secondary to the patient in front of us. And it's really exciting and honoring to still see that, right? And we are getting better with money. I've noticed that in the last 5 years as a profession, but
same here.
It's really powerful to just see how much people care. And it stands in contrast to other professions that deal in people's well-being. Because we simply have always relied on, in Canada, a government payer as a model, right? And many of us are hospital-based, so don't necessarily deal with some of these issues of overhead and practice management. But at any rate, as I went through this process, it forced me to really look closely at finance and ask myself, like, what do I do if I get sick, right? I've got, these lives that depend on me, and I don't want Jeanette to worry about things if, something happens to me. How do I take care of her? How do I take care of the kids, right? And eventually that led us to, we started a medical podcast called the Primary Medicine Podcast, very, very popular on iTunes and Spotify. And I really credit my business partner and the founder of that, Dimitri Ranev, who is an incredible family doctor out in Ottawa and Gatineau, Quebec. So just a quick shout out there. But after the podcast launched, we started to get really successful. We said, well, maybe we should put on a conference. And this was in late 2015. And we said, well, everybody does a medical conference. What if we talked about money for doctors?
Yep.
And that was the basis for physician empowerment. And so this project now is, into our 6th year, and it's been incredible to meet physicians from coast to coast. And we connect with people now in the States, even Australia. We had somebody, reaching out to us. And it's so incredible to share in each other's lives. So we teach finance, but it's bigger than that. We teach wellness. We teach practice management. We teach leadership. We show you how to improve everything, to truly transform your life, because money isn't really the solution here. We all kind of think it is, if we were better with tax planning or investing, but it's bigger than that. And we'll talk a little bit more about that as the podcast goes on, but let me just put that out there, and we'll come back to it.
I love that, because I think you hit the nail on the head, because, money is only, or managing your money is only a portion of what you have to do. The other part is the mindset and bringing balance into your life. So I think what you guys are doing is great, Kevin. And I think you said 6 years into it. So you can tell you guys are dedicated, devoted to this. So keep up the good work. Honestly, I think you guys are doing a real service to our colleagues. And, before we just jump into the real estate, I want to know, so you said $300,000 in debt, paying the nanny a lot, raising 4 kids. So without kind of diving into the weeds, I know you said you incorporated early, you were paying yourself dividends, but what are some of just the big ticket things that you think you and your wife did to kind of get back on track financially?
So the big one is, and we talk about this at the course, and we actually have little charts and things like this. If you come to one of our events, we'll explain to you. But one of the biggest traps that people make when they first step into practice is they start getting those large paychecks. There's a ton of delayed gratification. I mean, for myself, I graduated at a young age. I graduated at age 29.
Yeah.
I graduated from residency, but it had been 11 years straight of educational endeavor. And there's all that delayed gratification. We say, like, I've given up so much. I actually gave up my 20s, right, to become a doctor. A whole decade of, maybe the best years of my life. I doubt it. I'm loving my 30s. Maybe the best decade of my life. Probably not. I think I've got even better decades coming ahead. But
absolutely.
The bottom line is that, it's that temptation to be like, oh, wow, I want the big house, the car, the vacations, but those things, they actually carry very large costs tied to them. And we explain this in a lot of detail, but it is not just the sticker price you're paying on that car. It's the personal tax for when you take that money out of your corporation to pay for that car. It's, if you drive a high-end vehicle, it's the $500 service appointments every 3 months, right? It's all of those things. I mean, it's you buy the big house, there is a big property tax bill attached to that house every year.
Yeah.
And once you permanently lock yourself into those high expenses, it is very difficult to generate a robust monthly surplus to invest.
Yeah.
And I think for us, the key was we spent those early years still living like residents, and I was working nonstop to pay off student loans. And so it was a combination of like just working my tail off, and we kept expenses low. Like, so we had 6 of us in an 1,800 square foot apartment that we were paying $2,200 a month for.
Good for you. Wow.
And it was incredible because I was like, wow, I'm working, I'm earning these paychecks. And to be able to just keep expenses low and then pay off those student loans felt so good to get free like that. But then to say, okay, well, now we paid off student loans, let's start looking ahead. Let's get to the next thing. And for us, that was real estate.
Perfect. A lot of that resonates with me. It's one of the reasons I downgraded my car from an Infiniti Q50 to a Mazda CX-5, but I'm happy because it gets me from point A to point B. So still trying to live like a resident in certain ways. But, okay, real estate, let's get to the bulk of this. So I know you are definitely pro real estate, or I know you do focus on it in your investments, and I've even learned a lot from you on real estate through a few conversations. So, thank you for that. But tell us, what led you to start investing in real estate? And then maybe just give us a kind of a summary of what type of real estate investments you kind of hold.
Yeah. So we'll go through like what got me here, and then, what here actually means. And then I'll tell you where we're going. Because I think all good real estate investors actually mature and grow beyond where they start.
Yep.
But yeah, for me, real estate kind of came in a sense like, I have family members with a few rental properties, and it was very easy to wrap my head around. You own it, somebody else pays the mortgage, and eventually that mortgage is paid off. And now you have this asset that not only generates cash, but is paid off, and it's worth something. And in theory, it continues to appreciate. So for me, that was very basic. I felt like I didn't really have a head for numbers in stocks and equities. And I was also like you, we're the same age, Yatin. We both watched the financial crisis melt down the stock market. And I know it's recovered incredibly since then. And, but it was kind of like, oh, but I felt like I didn't have a lot of control over that. You know what I mean? Like, and so for me, I was just a little leery of stocks, whereas real estate was really easy. And then another part of it was, I understood incorporation at a very early stage. Like I said, I incorporated before my first day of practice, but I realized this, and I want to leave this with listeners, and we explore this in our financial seminar. So I'd encourage you, if you want to know more, come and join us. But the power of incorporation is not your ability to take money out in the form of income splitting or dividends. It's the power to keep money in and pay a lower corporate tax rate while you build wealth within holding corporations. So essentially, I just went out and started buying single-family dwellings. And I've got a sizable portfolio now. And I have what we call good problems. I'm busy with it.
Yeah.
Right? And, I was just telling Yatin before the call, I've got 4 kids, and the older 2 are 14 now. And they're able to do lots of work. And once they start driving, I'm going to be sending them all over the place to manage that portfolio.
Hey man, get your army together.
Good.
Get the army together. Put them to work.
Yeah. I've got a pickup truck, and I've got a 14-year-old daughter that's she's a good kind of country kid. We kind of live I've got a lot of family in the country and stuff like that. She's kind of a good country kid, and she tells me, even though we live in an urban area, she says, "Dad, I'm taking your truck. You get the Hyundai station wagon." And that'll probably actually happen. But the twins are wonderful. Like, and our younger two will eventually get there as well. But yeah, so I have what we call good problems. And I won't say over, how many doors I have. That's the term a lot of us small real estate investors use. I won't say how many doors I've got, but I've got enough now that I'm busy with it.
Yep.
It generates a lot of cash flow.
Yep.
And it's fun in the sense that, like, you're able to really truly watch over your assets.
Yeah.
And as I've gotten bigger, I hired a property manager, which has been instrumental. She's incredible. She's a realtor by trade, and her main job is as a realtor, mm-hmm. but she's manages a few properties for a few select clients, and so I've been very grateful for her. So the takeaway from that is as you build your real estate portfolio, you really need to have a team in place, and that can be formal supports like my property manager, or informal supports like kids that are well trained to swap out appliances and move furniture or whatever needs.
So right? That's really, really good info. So let me just ask you the next question. So some people who are contemplating getting into real estate, they say, "Oh my God, I've heard that this is not at all passive. So let's just create a little scale where 0 is like the most passive investment you could make. You could sit at home, have your feet up, not do a thing." I don't think owning real estate falls into that category. Or like go to 10 out of 10 where you're constantly getting phone calls about floods, blocked toilets, what have you. Like, in your experience, you now have a property manager, but like, how active versus passive, where does it fall on that scale?
Let me open with a great story, and then I'll take you through the whole spread across real estate. Or at least most of the spread in real estate, because real estate can be truly passive. So I'll never forget, I was working a run of night shifts, and then I had to fly after my final night shift. Basically I have to get in my vehicle from the Emerge, go to the airport, and fly out of province. And it was lumbar puncture night that night. Don't ask me why, but everybody seemed to need a lumbar puncture. They're time consuming for those of you that do them. We don't get anything fancy like, fluoro or ultrasound, like just good old fashioned. Like,
so you guys still do your own lumbar punctures? Because I find like we're doing them all in radiology now.
Oh, really? No. And I work in a standalone emergency department, okay. So we do not have any in-house anesthesia or interventional radiology. Yeah. So it is all me. And so it was lumbar puncture night. It was single coverage, of course. It was only me on, and I did 4 that night.
Oh man,
like 4, in addition to all the other emergencies that needed to be handled. And so it was a busy night. And I was in my car on the way to the airport, and I get a call from my tenant being like, in the apartment building, there's water coming from the ceiling. And I went, oh my goodness, I got to be on a flight soon, right? So, I scrambled over there with my dad. This before I had a property manager, when I was still thinking I could do this all by myself. I showed up there and I'm like, oh my goodness, what are we going to do? And then my dad handled it, and it was fine. But it was just like an example of, it is like when you do that direct ownership and management, it can be very hands-on, and it can happen at the worst times, right? When you're on vacation, or, when you have lumbar puncture night like I had, or whatever it is, those things can happen. But real estate, it can be passive. And I'm just going to take you through a very kind of flyover overview. So on the one hand, I have a physician empowerment client who's incredibly hardworking family doctor in rural Alberta, and he actually built a 4-plex. Now, he didn't pound the nails, but he went and found the land, found a builder, built a 4-plex, and filled it up with tenants. And that was like, he just went out and did that. And then, as you manage your own properties, like I do, or like that physician empowerment client does, it can be a lot of work. Okay. And there are always going to be issues that come up, and it just depends on what your stomach is for those issues. And some people do a lot of their own repairs. I do a lot of my own repairs only because I want to prepare the children for life. Mm-hmm. And I like that time with my older kids where we work on those things.
Yeah.
Some people hate that stuff and have no head for it and no time for it, and they just hire it out. So that's one option you can do with direct ownership in real estate. So you can have a great team of contractors that the minute something goes wrong, your tenant phones you, you phone your contractor, you get them out there, and you don't even have to look at the property.
Yeah.
Right. And you can have a great property manager that will handle everything, which mine does, and so, yeah, you have to be prepared to take those phone calls, but you don't actually have to go and deal with the problem yourself if you have a trusted team and you're not just going to get overbilled for work that didn't really need to be done, or an appliance that didn't need to be replaced, or whatever it is. When you come, I should mention, we've got a big event coming up in June of 2022 where we do a deep dive on real estate for doctors, as in how to make it work for a doctor. And we've got some online seminars coming out throughout the year where we'll touch on some of this. There are ways to do it when you're a busy doctor. We're a busy 2-physician household, right? And we still have a sizable real estate portfolio. So that's the one end where you're very hands-on. The power of that is that you maintain a lot of control over it. You have a lot of peace of mind in the sense that you know what's going on with your investment, because that's what it is. And the returns can be very strong, like 15, 20% annualized. And I will explore that later in the episode today. We'll go through that very quickly. And then on the other end of the spectrum, there is REITs, which I wouldn't necessarily recommend investing in. It's a stock in a company that, you can look them up. And Yatin, have you done an episode on REITs yet?
No, but I'm sure it's interesting you mentioned that. There will be one upcoming, I'd say, in the next 3 months or so. Yeah. So, but REITs got some downsides. They're not really any different than any other, post-IPO stock. You're the last to eat, and you do not enjoy the power of real estate, which is appreciation. Well, maybe a little bit of appreciation, but leverage. You don't enjoy that. And so you're looking at much lower returns. In fact, REITs might even be underperforming, the stock market in general. And you have no control over it, right? And so REITs are required to pay out profits to shareholders, but how they manage or mismanage the REIT is really out of your control. But it is truly hands-off, right? I mean, you buy REIT stocks, and I have REIT stocks. You buy them and they're there and they're bringing in cash. And then there's a lot in between. And I'll just touch on some of that. And this is the thing that I think a lot of doctors can really get into and enjoy. And these are private equity plays in real estate, using your corporation. And I remember one year, so we had somebody come and attend our Toronto-based family physician. He attended one of our seminars, one of our conferences, pardon me. And then the next year, he asked to speak about RELPs, real estate limited partnerships, and how powerful that was. And he invested all over the GTA and just made staggering sums of money. There is some risk with it, but it's set up as a limited partnership, right? So you're on the hook for what you're on the hook for. And, and this and there's a lot of variety there. Like, don't feel like you have to go throw in $1 million on a $30 million project. It can be much smaller. I mean, we're setting up a real estate company where the minimum investment is only $50,000 and there are no loan guarantees. You don't have to sign for loans or mortgages, right? And you can invest in, like I know a psychiatrist based in the GTA. Everything's going on in the GTA. There's a psychiatrist that does private equity deals, and he does a lot of single family homes and row houses and sets these up, and doctors invest in this. And these things are maybe not, well, that's not true. They can actually be higher than direct ownership. And you write your check, and when the project comes to completion, you get your money back plus the profit, right? And the profits can be paid out monthly. There are different ways to do this, and we'll explore that in a lot more detail in our June event. But the bottom line is, those are ways for doctors to use their high earnings, their residual corporate income, to invest in real estate and have it paid back to a holdco that they control. Or, I mean, you could use your PC, but I don't generally recommend that. Just set up a holdco, which is super easy. And that allows you to invest in real estate, and you can invest in localities that you're comfortable with, like invest down the street. I mean, there's a trust issue. You have to find partners that are going to get the project done, that are going to pay you, that are not going to take your money. So there's nothing without risk,
but those returns can be very, very powerful. And it's the other thing that I love about real estate is it's a great thing to do once you've sort of maxed out your TFSAs, RSPs, RESPs, even if you're really conservative and you're like, you know what, I don't even want to have a personal mortgage. So you're one of those, types that just pays off your personal mortgage. And now you're sitting with this residual cash coming in through your PC and you're going, well, I don't know where to invest. Real estate is an incredible opportunity. And there's different horizons, right? Like that's the other thing I love about it is, the buy and hold model that I currently have with my portfolio is kind of like a 25-year horizon, but there are others where it could be a 36-month turnaround.
Yeah.
Right?
No, I think you've given us a lot of good stuff here, Kevin, to think about. I know that
there is so much.
Yeah, the people who advocate for REITs, I think their experience is that they've had people who've tried real estate, found that maybe it was too active or maybe it just wasn't done the right way. Like you said, there's a team in place, but then they enjoy the passive nature of REITs. But I totally get each thing kind of has its pros and cons for sure. And, thanks for mentioning June 2022. I'll try to bookmark that because it sounds like your seminar will have some useful information.
You know what? Yeah. It's incredible. Yeah. And it feels so good to be able to offer a live event like the in-person Toronto conference. We've done it for years, but we had to put it on hold because of the pandemic.
Yeah.
But very, very excited to be resuming it.
So before we dive into the numbers, I just want to hit a few quick things. So we talked about real estate can range from more passive to much more active. So you're going to have tenants if you're going to become a landlord. So while we're on this, can you maybe just share a few tips for helping select the right tenants in your experience?
Yeah, honestly, it can be really tricky. A little bit of advice, for those of us that manage our own places, I typically because you're not in a cash flow position, you don't have a concerning cash flow. If your place needs to sit vacant for a month or two while you find the right tenant, that's the first piece of wisdom I would share with you, because you don't want to just say, oh, it's vacant, I got to fill it. Well, no, you've got enough income that you can carry a single family home for 1 month, right? While you find that right tenant. The other thing that I strive to do is, we rented for years. And I remember, struggling month to month with my own expenses. I actually strive to keep my rents below market. There are some people that would say that's terrible. But the truth is I strive to keep my rents below market, and I strive to increase rent rarely and minimally. And the reason why I do that is that as the guy that's got to manage the places, or at least deal with the vacancies and the turnover and any potential damage or repairs that need to be done, those things disrupt my time from family. Mm-hmm. Those things disrupt my time from my career. So they're not worth it. So if you can keep a tenant in and say, let's say $50 below market, and they're happy and they're going to stay for years and they're going to settle and they're going to take care of the place on their own, that is worth everything.
Okay.
It's enormous peace of mind. Not that, I've got places that I had a place I never even stepped foot in. Is that silly? But my property manager, who's a realtor, found the place for me, found a tenant, and put the tenant in. And the tenant was so happy that I just never needed to even go there to deal with anything.
That's what you want, right?
My dad, and again, some people would say, well, that's crazy. You should be checking in on your place every 6 months. But no, I'm a busy doctor, 2 physicians in the household, 4 kids. If my phone's not ringing, I'm not going to go looking for a problem. I actually met a landlord who hadn't gone into the place he owned for 30 years. He hadn't stepped through the front door.
Oh, man.
Because it was this couple that rented the whole time. And anytime something broke in the house, they would just leave the receipt in the mailbox and he would reimburse them because they would do their own repair. And he didn't increase rent, so they didn't feel any pressure to leave. And again, I'm not saying that's the right way to do it, but maybe it's the right way for some of us to do it. Because if it gives you peace of mind and you have a good quality tenant who's paying every month and taking care of the place like their own, you can't ask for more. So if you're sitting there, constantly trying to bump rents, it's going to lead to turnover. And turnover is not just the vacancy; it's the repairs and the cleaning that go with it. And it is, more importantly, your time.
Yeah.
Because I love real estate because real estate gives me peace of mind, but it means I have to do it in a way that gives me peace of mind. That's what's key. And that's what we teach at our real estate course for doctors is how do you do this so that you go to bed every night happy, right? Not stressed out.
Very useful tidbits there, Kevin. Now, you mentioned the holdco, the holding company. So, do you invest in real estate exclusively through your holdco rather than personally or through the corporation? If so, why? Maybe just kind of talk us through it briefly.
So a lot of people are intimidated by this. I have like, I remember the first time I set up a holdco, I was like picking a name. Yeah, it was, one of the children's Hebrew names actually is the name of the company.
Yeah.
Because I thought I had to, and then like 6 corporations later, 6 corporations later, they're all just numbered. I actually got another one that's under another child's Hebrew name.
Yeah. For my holdco, it's our initials, everyone in the family. So we're a unit,
cute,
so
right?
You make it creative.
Yeah, exactly, right? Something, special, right? And the truth is, like, for a lot of people, like, come up to us and they're like, well, how do I set up a holdco? I can tell you, it is so easy.
It is.
You can talk to your accountant, but like, it's as easy as, and I'm not giving you advice, I'm just telling you how, as an illustration, just phone your lawyer and say you want a holdco with 100 Class A shares in your name. That's it. Right? And so what that allows you to do is it allows you to transfer funds from your PC to this holdco, and then this holdco can go and invest in anything, right? Like the holdco could go buy stocks and bonds, like go buy REITs. The holdco could get involved in private equity deals, for new construction. The holdco can go and own a property personally. I would never, under any circumstances, advise anybody to own any property with their PC, whether it's a clinic that you practice out of, or whether it is, an investment property or your own personal residence. Do not own it with your PC. A holdco is like a $1,500 thing to set up.
Yeah, for me, it was a phone call to my accountant and $550. So I'll talk about maybe a few pertinent things about the holdco, and you just tell me where I have it right, where I have it wrong. So for me, my understanding is the holdco, it's separate from your operating company, which is your corporation. The corporation can loan money to the holdco tax-free, and there's really no deadline for return of those funds, but one day they'll have to be paid back. And so basically by investing through the holdco, you're essentially removing that risk from your operating company, right? You're separating it. And what do you think about that? Is that correct?
You never eliminate risk. It's all about risk reduction. Okay. If you want no risk, then you're looking at limited partnerships and you're looking at REITs. What to truly manage risk is you need robust liability insurance, right? And you're right on the tax implications, because you've already paid the tax. So let's say you had $100,000 in residual income within your PC, and I'm going to put it out there. There's a corporate tax rate of 15%. So you're left with $85,000. That $85,000 can be transferred over to the holdco, and you can go out and buy a property. And in Alberta, that's enough for a 25% down payment because Alberta's so affordable. I'm not bragging. Well, maybe a little bit, but it is so affordable to invest in Alberta. It's unbelievable, right? I mean, you're in Toronto, and so you live in a different world. Yeah,
it's a different animal out here. But basically, so you're using those tax deferred dollars. You paid the 15% tax, but the rest is going to be tax deferred. So you've got a larger sum in the corp than if you were going to pull it out personally and invest personally, right? So this is essentially the argument for the holdco, right?
Oh yeah. And it's so easy. Like all my accounts are linked online, and I just shuffle money whenever money needs to be shuffled over. Like it's just, and you do need a good accountant to record all of these shareholders' loans, but you don't, as far as I'm aware, you don't need to attach an interest rate to them because it's kind of meaningless. You've already paid the tax on it, but just make sure that you have the loans recorded. And that's, again, you need a very good accountant for that. So don't cheap on that.
But I just want to challenge the holdco a little bit, because a listener recently asked me, she said, listen, I'm contemplating investing in real estate, and I'm wondering if I should do this personally or through a holdco. And this is my first property. So I guess my question is, if you're just starting, do you need a holdco right away?
So this is interesting. You don't. Here's the issue. Let's go back to that example of $100,000 in retained earnings in your PC. And you want to take, so you want to buy it personally, right? So you're going to pay yourself out a dividend or salary. And what are you going to be left with in Ontario? $47,000 left? Wasn't the top marginal tax rate 53.3% in Ontario?
Yeah, exactly. Yeah.
So you're left with $47,000 to buy that property with. And on top of it, if that property is generating income, now you're paying income tax on that. And given that you're probably, as a hardworking doctor, you're probably in the top income tax bracket. And so like, if it's going to be something small scale, go for it. I actually have one property in my own name personally. That's just kind of a whole, I'll tell you about that one offline. It just a funny story. There's nothing bad about it. It's just, there's no time to cover it here, but
No
it's
problem,
just a funny story about how we moved from Edmonton to Sherwood Park, and I couldn't sell the house that we lived in, so we converted it to a rental property. There, that's the whole story.
Okay, interesting.
And so we left. Yeah, so it's just sitting there. It's outside of it's outside of our corporate structures, and we've got a wonderful family doctor and his wife renting it, and it worked out well for all of us.
Okay. Okay. Good to know. Good to know. Now, Kevin, let's dive into the numbers a little bit. So I know you have been very helpful to me, even in kind of guiding me on how to objectively assess a real estate investment. So whether it's a single family home, a condo, whatever have you, maybe you can kind of just take us through the steps or the parameters, the metrics that you look at when you're objectively assessing, is this property going to be a good investment?
Yeah. So, you'll see real estate pro formas that are these giant spreadsheets, and you should see what my business partners put together when they're looking at either single family homes or I've got business partners that build apartment towers and things like that, bigger projects, and it's staggering what they'll put on a spreadsheet. Maybe I shouldn't say this, but the Kevin Mailo method is much closer to doing it on a napkin.
Okay. If I can I like that. I like that. I'm a simple guy, so bring it.
Yeah. So this is why I love real estate, because it can be as simple as that. Like, you can put it on the back of a napkin, and I'll just take you through it very quickly.
Sure.
So this is why real estate is so powerful, and why I think every single physician in this country needs to look at it. Because real estate creates gains in three ways. Number one is the cash flow. So let's say, okay, we're going to use an Alberta example. Let's say you put $80,000 down as a down payment on a single family home in Alberta, or let's say, actually just say do $100,000 down on a single family home in Alberta. And after you're done paying out mortgage, taxes, utilities, vacancy, repairs, whatever on that home, and you're left with, let's say, $300 a month in positive cash flow, that's $3,600 a year in positive cash flow. That's a 3.6% return on your $100,000. Yep. And a lot of people go, oh, wow, great. I can do much better than that on the stock market. But that's nothing. That's the tip of the iceberg. That's only one very small consideration. The real power of real estate is the other two elements: appreciation and mortgage pay down. So let's say this $400,000 property is appreciating at 2% a year. So $8,000 a year in appreciation. Is that right?
Yep.
I struggle with public math, everyone. That's my confession, public math. And then, but the most powerful thing is the mortgage pay down. And you can actually go and see what a 25-year mortgage pay down rate is. And in the early years, like the first 3 or 4 years that you carry a mortgage over its 25-year amortization, you're paying mostly interest.
Yep.
But then that rapidly switches to paying mostly principal. Mm-hmm. And this is huge. This is in the thousands and thousands of dollars every month. Or every year, pardon me. And this is where real estate, even just direct ownership of single family homes, approaches 15, 20% a year in annualized returns. And I'm going to go through some in detail examples at the conference coming up in June. And if anybody wants to reach out to me on this, we always take calls. There's no charge. We love to talk about these issues in our lives and why real estate is so powerful. So you can always just go to physicianempowerment.ca or phys-empowerment.ca, YS-empowerment.ca, and just come and connect with me. It's really easy. And I'll take you through some of these examples in more detail. But the bottom line is real estate brings real peace of mind when you look at those numbers and you go, wow. And the other way, and I've explained this to you, Yatin, when we've had conversations before, the other way I think about it is you take your $100,000 and you think of it like a seed and you just plant it. And all you got to do is just make sure that it gets a little bit of water, as in you pay your taxes, you make sure the mortgage company's happy, and you make sure you got a tenant there. And even if it doesn't generate a lot of cash flow, that $100,000 in 30 or 35 years is potentially $1 million property.
Mm-hmm.
That's where we've seen house prices appreciate at 3% a year, 4% a year. It'll go up to like $1 million.
Yeah. Yeah.
Over 30, 35 years. So now let's say you had 10 of those $100,000 seeds and you planted them. And then in 30 or 35 years, so let's say you had $1 million that you managed to scrape together over a decade, and every year you put 100,000, 100,000, 100,000 to a total of 10 properties. And in 35 years, each one of those is worth $1 million.
Mm-hmm.
You now have a net worth of $10 million that you do not own a mortgage on, that you do not carry mortgages on. And even better than that, again, nobody really holds for 30 years, but this is just an example. Even better than that is you now have 10 tenants paying you whatever they're paying you in rent, which is huge income, right? I mean, so if rents go up at that rate, let's say you've got, just keep it really simple. Your rent started at $2,000 a month in year one, and by year 30, they're $4,000 a month. You've now got $40,000 a month in revenue coming in on a $10 million portfolio.
Yeah.
Who is getting that from the stock market? I challenge, and it's not one or the other. I'm not trying to throw down the gauntlet and have a Kirk versus Spock here. It's really just about like thinking about those numbers.
Yeah.
Right. The real estate goes up like 15% a year in direct ownership while you're paying the mortgage. Once the mortgage is paid off, it's all gravy. Right? Like it just keeps going.
So has that been your experience then? Like average annualized returns of 15% or so? Is that kind of accurate for you?
Yeah, like that's roughly where I would put it. And I'll show you the math on that. Like we can go through the math on that. Like if anybody wants to reach out to me, and obviously if you come to our conference in June, we will go through this in a lot of detail with some really great examples. And you go, oh, wow. Right? But think about it this way. $100,000 for a $400,000 home. Again, Alberta examples, really affordable housing market. But you're going to get $3,600 a month in, or $3,600 a year in cash flow. Let's say you're going to get, another $8,000 in appreciation, perhaps, and then you're going to get another whatever $5,000 ish or more in mortgage paydown in those early years, right? And the mortgage paydown changes; it increases as you go through. And again, I can show you some tables and some resources. But there it is. There's your 15%. There's your $15,000 on your 100. And you own the asset. It's real. It's not going down below what you paid for. I know there are all these doomsday scenarios. It's not going below what you paid for.
Well, we're going to talk about that in a second. You've talked about cash flow. You've talked about mortgage paydown, which for sure is very powerful. And then you've talked about appreciation. But I just want to challenge cash flow a little bit, Kevin, because I've talked to people here, and these are people who may be listening to the podcast, but we've had conversations and they've said, listen, like we're looking at places to invest even outside of Toronto. Like we're going out into like Cambridge, Brantford, Kitchener.
Yeah.
And it is really hard to find positive cash flow. So I guess my question is,
in some markets you will not.
It's I think it's impossible out here. Yeah. Are you finding some positive cash flow in Alberta? Is there still positive cash flow out there?
Yeah, there is positive cash flow in Alberta.
Okay.
And cash flow is always the thing you got to work for. But here's why cash flow is the least important part of that. So let's say your negative cash flow, $100 or $200 a month. Like number one, you can totally afford to carry that. It's a write-off. But number two is like, let's say you've got 10 properties and let's say they're renting for $2,000 a month. So you got $20,000 a month in revenue coming in and you're paying down the mortgage and those properties are going up in value. And it costs you what? $24,000 a year to enjoy $240,000 a year in revenue. Is that right?
Yeah.
That's huge. It's all about the cash flow, right? That's a powerful thing in our lives. And remember that once those things are paid off, then the $2,000 a month is just yours. And you don't have to worry about the cash flow.
So you mentioned the write-off. So maybe, Kevin, we can take this and segue into how is real estate or how can it be a tax-efficient investment?
So, I mean, there are lots of things. The taxes are write off. The repairs are a write off. The losses you carry are a write off. The interest on your mortgages is a write off. Even smaller things like, tools, supplies, equipment, whatever you use, are all write offs. So there's a lot there. And again, you're not really going to enjoy those until later years when you've really moved into, if you're under a buy and hold model where you paid everything off.
Yeah. So maybe we can just, steer towards a potential doomsday scenario just for, thoroughness here. So when did you buy your first property as an investment? I'm just curious.
I bought my first property in my first year of practice. I was really aggressive.
And what year was that?
2014.
2014. So I guess, okay.
14? Yeah, I think it would have been 2014, I think I bought.
Perfect. So as devil's advocate, like you and I, we're still early career physicians. Although you kind of, Kevin, and this is all meant to be positive, I think you have more an aura of a mid-career physician. You just seem to know a lot. And that's...
I'm like an old man.
No. That's meant to be a compliment. But
honestly, you can ask my kids. Yeah. No.
But I guess my point here
I'll take it. I take it as a compliment.
Yeah, no, it's a compliment. So my point here, though, is that you and I have not invested through a period like the financial crisis, which obviously, it hit the U.S. really hard, but the impact was felt here. And then there was the housing market crash in the late 80s going into the early 90s, in Ontario and Toronto. So, we haven't invested through that. So somebody may say, okay, right now we're investing in a pretty rosy period for real estate. So if something like that, a bad period was to happen, it could happen. What's your take on that, Kevin?
So I'll draw on my old guy experience. I've actually been through 3 major cycles in Alberta.
Uh-huh.
So we had a house in medical school. That was a big mistake. If you've got any medical students out there, don't buy a house in medical school. That was a money pit.
Yeah.
So we went through the 2008, 2009 oil crash in Alberta. Mm-hmm. And then we went through it again in 2015. Mm-hmm. And then we went through it again in the pandemic. So I've been through 3 cycles already.
Okay.
And yeah, you know what? Absolutely. There are those moments. And like all things in life, you just have to have some cushion, right? So the advice to get through economic downturns and cycles in the real estate market is to do not be so greedy that you have over leveraged yourself. Banks are going to lend you lots and lots of money as a doctor to go out and do these kinds of things. But you have to be mindful not of, like, banks aren't out there to look after whether you can pay for it or not. Really, it's got to be you. So I always advise that, that physicians have emergency funds mm-hmm. to float properties. Mm-hmm. You are in a far better place if you have multiple small properties, like single family dwellings. You are in a better place than if you have one big one. So you go out and you buy like let's say, an office building or something like that, and you got some staggering, you're paying commercial rates on your mortgage. You've got taxes that are much higher, whatever it is. You got to be prepared if you're going to play in some of those deeper ends, you got to be prepared with some cash to float yourself. Okay. And so that's the advice. There are downturns. I know people keep saying, and I'm aware that people think that real estate is just going to go up perpetually in Ontario and in the lower mainland of Vancouver. I do have worries about those markets. Not so much with interest rates, but just, a change in the economy or whatever, or demand. And some of it, frankly, is I worry like owning real estate in some of those markets isn't even profitable now in the good times. Even a slight slowdown can put people into a very long-term negative cash flow position.
Yeah.
Or a position where all of a sudden, like, let's say, everybody's overbought the condo market and are not getting the rents they need and are no longer seeing the appreciation that they wanted and are forced to sell. And then everybody's trying to like unload in the market.
Yeah.
And that depresses prices further. I mean, there are some real risks to that, right? But the nice thing about real estate is you actually choose your own amount of risk.
Yeah.
You choose your own risk when you decide how much to borrow. So don't feel like you got to go out there and step into it for millions of dollars on a single project, right? Or don't feel like you got to go step out there and buy 10 homes this year. Go slowly. buy one. I mean, I know successful real estate investors that basically did it all cash and lines of credit.
Yeah.
Right. And it's not about, and this is the bigger financial lesson. This is something we teach at Physician Empowerment. This is not about somebody else's path. Like, don't go buy real estate because I love it or my business partners love it. Go buy it because you want something like that.
Yeah.
And whatever you do, it has to be consistent with your values as a person. And the criteria that I use in addition to that is, am I sleeping well at night?
Yeah.
Am I sleeping well at night? And that's why I don't pick individual stocks for, our stock portfolio, because I want to know where they're going up and down. I want to just sleep at night and not worry about it, right? And so that's what you really want to use as an investment criteria beyond just the numbers. I mean, anybody can put out the numbers, but it's like, can me and my spouse or partner sleep at night? Is this adding to our lives?
Mm-hmm.
That's a key criteria. Is this investment bringing me closer to my dreams? Is it providing me with, financial security? Is it providing me with peace of mind? Because if it's not doing those things,
Mm-hmm.
then don't do it. That's my advice to you. Don't do it. Don't let somebody sell you into that. Don't sell yourself into that. So you choose how much debt you take on when you invest in real estate. And that can be anywhere from 0 to millions.
I think that's very good advice, Kevin. And as we wrap up, I just a couple more questions. So for you, biggest mistake in real estate investing?
Yeah, this is a great question that I kind of have mulled it in my head for years. Here's my biggest regret. Worry. I've been through 3 major real estate cycles in Alberta. And I always thought about these doomsday scenarios. And I just thought like, oh, I'm not going to be able to carry it, or it's going to be so bad, or it's going to be this, it's going to be that. And you get through it. And that's the thing, right? But that's a broader life lesson.
Mm-hmm.
Is that we spend so much of our lives, like so much of this moment in our life is worrying about something, and it never actually ended up being as bad as we thought it would be. And that's the kind of thing that I would say I wish I'd done less of over the last 10 years of being a landlord is the worry that I carry.
Okay.
Because the truth is most things actually turn out just fine. And even when they're bad, they're not as bad as you think they are. And so take the long view with real estate, just like you take the long view with the markets. Take the long view with real estate. Take the long view with life.
Yeah, I agree with that, thinking long-term, although my wife keeps me in check. I think I'm such a long-term thinker that there are days when we're debating and she's just like, listen, I want to have some fun now, not when we're like 60. So I get it. She kind of helps me to live in the present. And so we balance each other out that way. But I agree with you fully. Real estate, long-term game. I made a mistake buying and selling quickly, which I'm going to talk about kind of later. And Kevin, last kind of real estate question is, I'm assuming when you're investing, when you're getting a mortgage, most of the time it's going to be a variable rate just to allow for more flexibility. Is that safe to say? Or
no, honestly, I've got a mix of variable and fixed, just depending on what I could get. Again, rates are low. They're probably going to stay low for a long time. And that again is a personal choice. If you just want the peace of mind of knowing what your cost is going to be over the next 3 to 5 years, go for the fixed rate and don't beat yourself up about it if you could have gotten better on a variable. Or in the end, this all kind of comes out in the wash. Again, you just focus on the long view. There are many, many things in life. Like think about what you blew on that night out going for dinner with friends. And like, that's going to be the spread on your variable versus your fixed, right? Like look holistically at your life when you're considering these things, right? And that's why, when lumbar puncture night happens and my tenant phones me about flooding from the suite above, you just get through it. Honestly, you get through it. And that's one bad day and out of hundreds of great ones, thousands of great ones.
So Kevin, last question is, any advice for our listeners? It could be related to real estate. It could be related to just anything in general. I'm just going to leave you with the mic now.
Yeah. Physician empowerment's grown a lot over the years, and we started out being strictly finance, and we still do finance. We love it and we're good at it. But I think the thing is like, we all need to be looking at bigger things than money in our lives, that it's not about billings and taxation and, chasing yield on investments so much as it is about like investing in ourselves. And that was something that's really kind of hit me over the pandemic. And as physician empowerment's expanded, starting to think about like, who am I investing in? And And it can't just be the markets and real estate. It really has to be in myself, right? And that means personal wellness, self-care, sleep, time to recharge, time with family, the things that actually matter. Like your wife talks about, like living in the moment now, right? And really just celebrating where we're at right now, and not always just kind of constantly chasing that thing in the future. And so that's my advice. I'll just leave with one last thing. This December, I mean, who knows with the pandemic, we are partnered with Sea Courses. We are headed to Mexico, beautiful Cancun, for an incredible conference on wellness and practice management. It's worth 16 Main Pro Plus credits. We'd love to have folks out. It's a wonderful time, not only to recharge, but just to connect and build that sense of community. The thing that excites me the most about physician empowerment is not telling my own story, but it's about hearing other people's stories and other people's journeys. It is just so inspiring to see what physicians are doing in their careers, doing in their personal lives, doing with their finances. It's amazing. It's energizing to spend that time with fellow travelers like that. So that's the thing I'd leave you with, is just take time to take care of yourself and invest in yourself as the engine of your future prosperity, as the engine of your future happiness, and as, the person that cares for your family and the others that depend on you.
Kevin, that's great advice. And I think, you being in the position, and you've mentioned this to me, that you were, at a spot in your life where you felt like you were working too much. There were burnout issues.
Absolutely.
And I think you've experienced that firsthand, and you've kind of discovered the changes that need to happen to lead a better and more rewarding life. And it's really good to see that you are taking this to the next level and sharing it with our colleagues. I do think it is a very valuable service to offer. So I think, listen, what you guys are doing is great. And listen, there have been people who have been asking for a real estate investing episode. And in my mind, I felt like you were going to be the best fit. So thank you, Kevin, for joining me today, man.
I'm happy to share. Honestly, and I'm happy to share. And I'm so excited to see your podcast continue to grow and reach more and more people, because people just need to go over these issues and cover these things. It's so important. I'll just leave this for our listeners. If you want to connect and you want to hear more about physician empowerment and, what we have to offer, reach out to me. There's no obligation. Just come reach out to me, connect, talk over the phone, or we'll set up a Zoom call. But again, I'm just so inspired to hear from physicians all across Canada and the US who are doing different things in their lives, or even just hearing about our struggles. And that, if you're struggling with something, you don't have to feel alone. Trust me. We've all gone through difficulties.
Hey, Kevin, thanks again for taking the time today. It's always a pleasure to chat with you.
Absolutely wonderful to talk, and I always love it. It's amazing to just follow your podcast and see everything you're doing. It truly is a gift to our profession.
Hey, thanks so much, Kevin.
It truly is, Yatin, and I'm honored to be here. Thank you.
So if you want to get a hold of Kevin Mailo, the best way to do so is through email. It's kmailo, Kmailo, at physempowerment.ca. And you can also learn more about physician empowerment by going to physempowerment.ca. You can learn about the venture and some of the educational sessions that they hold. So guys, that brings season 1 of Beyond MD essentially to a close. I may be putting out a special episode soon, which kind of focuses on my mistakes and, more importantly, what I've learned from it. But I just want to give a few shout outs. First, to all of the guests who took part in the episodes. None of these episodes would have happened without you guys. And I think a lot of you people know that I'm a fan of blended content, where content is being provided by experts, but then it's being steered in the right direction by a physician, to make sure it's relevant to healthcare professionals. So thank you to everybody who took part. And then a big thank you to all of you who are listening. You guys are the ones who give me motivation to continue pumping out content. I am so grateful. And I have to say, I think the best part about the podcast has been connecting with people and making friendships. So to those of you who reach out with questions or just to say hi or to provide feedback, I am immensely grateful for that. So please keep it up. And you know what, as we kind of move on forward, let's just hope for, a good fall, some normalcy, especially for our kids. And in the meantime, guys, keep well, stay safe, please enjoy the summer, and cannot wait to bring you season 2. See you soon.